In this session, we'll be discussing about tax planning for amalgamation and demerger. First, let's see what is amalgamation. According to Income Tax Act 1961, Section 2, subsection 1b defines amalgamation as merger of one or more companies with another company or merger of two or more companies to form one company. So, amalgamation basically means either one company merges with another company or two or more companies merges together to form another company. So according to this act, all the property and liabilities of the amalgamating company or companies immediately before the amalgamation becomes the property of the amalgamated company. So all the properties and liabilities of the amalgamating company becomes the properties and liabilities of the amalgamated company. Next, shareholders holding at 75% in value of the shares in the amalgamating company becomes the shareholders of the amalgamated company. They automatically becomes the shareholders of the amalgamated company. So, what is amalgamating company? Amalgamating company means company which is merged, and the amalgamated company means the company with which it merges or the company which is formed after merger. So, if there are two companies A and B, if A merges with B, then A is the amalgamating company and B is the amalgamated company. Or in the other case, if there are two companies A and B and they both merge together to form another company C. So A and B are the amalgamating company and C is the amalgamated company. Next, let's see what are the tax incentives for amalgamation. So the tax incentives are given as for amalgamating company, shareholders of amalgamating company and amalgamated company. So now let's see what are the tax incentives for amalgamating company. So the amalgamating company gets exemption from capital gains tax. So when there occurs a transfer of capital assets from amalgamating company to amalgamated company, these companies get exemption from capital gains tax. Next, tax concession to foreign company. So if the amalgamating company is an Indian company and amalgamating company is an Indian company and amalgamated company is a foreign company, then for transferring their assets, the capital gains tax they had, they get concession for amalgamating into a foreign company. Next, exemption from tax liability on transfer of license to operate telecommunication services. So if the amalgamating company has obtained any tax liabilities from for operating in telecommunication services or for taking for obtaining license in telecommunication services or for operating from the spectrum of telecommunication services, for all these they'll get tax exemptions. Next, if plant or machinery is transferred. So if any plant or machinery of amalgamating company is transferred, they'll get tax exemptions for that. Next, let's see what are the tax incentives for shareholders of amalgamating company. So the period of so they'll get these shareholders will get tax exemptions on period of holding their shares of the amalgamated company. Their holding period for holding shares, they'll get tax exemptions in amalgamated company and exemption from tax on exchange of shares. Next, let's see what are the tax incentives for the amalgamated company, for the newly formed company or the company into which another company has already merged. They'll get exemptions on capital expenditure on scientific research and they'll get tax exemptions on expenditure incurred to obtain license to operate in telecommunication services. They will also get exemptions on preliminary expenses. They'll get exemptions on tax exemptions on expenses for amalgamation, and if they had any expenditures regarding voluntary retirement schemes, any expenses incurred on that basis also they'll get tax exemptions. Next, expenses on prospecting etc. on certain minerals. So if there is any on prospecting or on extraction of certain minerals also, these amalgamated companies will get tax exemptions. Next, they will also get tax exemptions on bad debts. They will also get tax exemptions on actual cost of an asset. They'll also get exemptions on actual cost of depreciable assets. They'll get exemptions on actual cost of depreciable assets rather than on their depreciation cost. Now let's see what is demerger. So demerger is an arrangement whereby some part or undertaking of one company is transferred to another company which operates completely separate from the original company. So if a part of a company or a branch of a company goes and is transferred and merged with another company, that process is called demerger. So it's also a type of amalgamation, but the thing is that either the part of the company or the branch of the other of one company moves to or is transferred to another company. So according to section 2 subsection 19AA of Income Tax Act defines demerger in relation to the companies means the transfer pursuant to a scheme of arrangement under the Companies Act by a demerged company of its one or more undertakings to any resulting company. So demerged company is the company or the part of the company which has been transferred to another company, and the company which is formed as a result of demerger is called resulting company. So we have a part of a company named A and another company named X. So this part of the company is called demerged company, which is transferred to the company X, and now the company X is called resulting company. So let's see what are the things, what are the other details in this section. All the properties or liabilities of transferred undertaking becomes the properties or liabilities of the resulting company. And again, the transfer of these properties and liabilities are at its book value, and the shareholders holding minimum 75% of the value of shares become the shareholders of the resulting company, as same as amalgamating in the case of amalgamation. Next, let's see what are the tax incentives for demerger. So in demerger also, the tax incentives are given in three ways, in three forms: for the demerged company, for shareholders of demerged company, and resulting company. The tax incentives for amalgamation and demerger is almost similar. Now let's see what is the tax incentives for demerged company. In demerged company, they'll get exemption from capital gains tax if any capital asset has been transferred from the demerged company to the resulting company. They'll get tax exemptions on capital gains tax, and here also again tax concession to foreign company. So if the resulting company is a foreign company and the demerged company is an Indian company, their capital gains tax and any other taxes regarding their transfer will be exempted for the demerged company. So they'll get tax concession on to foreign companies. Next, exemption from from tax liability on transfer of license to operate in telecommunication services. They'll get exemptions to operate to obtain license to operate in telecommunication services and also to use the spectrum of telecommunication services. Next, if the plant or machinery is transferred from a demerged company to the resulting company, they'll get tax exemptions. Next, for the shareholders of demerged company, the shareholders of demerged company will get tax exemptions on the period of holding of shares of the demerged company, and they also get tax exemptions from tax on exchange of shares. Next, let's see what are the tax incentives for the resulting company. The resulting company will get tax exemptions on expenditure incurred to obtain license to operate in telecommunication services. They also get exemptions on preliminary expenses and expenses for demerger. They will also get tax exemptions on expenditures incurred under voluntary retirement scheme. They will also get tax exemptions on expenses on prospecting or extracting or etc. on certain minerals, and they will also get tax exemptions on expenses on prospecting or extracting of petroleum and natural gas, and they will also get tax exemptions on actual cost of an asset. And for the resulting company will again get tax exemptions on written down value of block of assets. In the case of amalgamating company, we saw that amalgamated company, we saw that they'll get tax exemptions on the actual cost of depreciable assets, whereas here we can see that they get tax exemptions on written down value of block of assets. So that is about amalgamation and demerger. Thank you.